We are going to keep this rolling. I get to bring forth another couple friends here. David Feldman, partner at Hiller PC and Skip Intro Advisors. How are you, my friend?
I'm doing very well, Patrick. Great to see you.
Good to see you. And Ankur Rungta, co-founder and CEO of C3 Industries. How are you?
Doing great, Patrick. Thanks for having me today.
Look at you, man. I'm just trying to look as good as you over there. I'm trying to up my game. All right, I'm going to get off and let you guys go to town.
All right. Thank you, sir.
Thank you.
We're thrilled to be here together. I'm here to do a little fireside chat with Ankur, and very honored to be here with you. Why don't you do a couple 3-4 minute kind of overview of the business and where you guys are at now?
Sure. No, thank you, David. Thanks for hosting this today. We'll give a quick background for those who aren't familiar with the business. C3 Industries was founded in late 2016. There are 3 primary co-founders of the business, myself, my brother Vishal, and our third partner, Joel Ruggiero. The company today is based in Ann Arbor, Michigan. We have about 250 employees in total currently, and we're active today in 4 states. That's Michigan, Missouri, Massachusetts, and Oregon. And in all 4 of those states, we hold vertically integrated licensing. So we hold cultivation, processing, and retail licenses in those markets. In total, we've got about 250,000 square feet of production capacity of cultivation and processing that's either active today or in construction. And that's spread out across the 4 states. And then we've got about 20 retail locations among the 4 states as well in our portfolio. 8 of those are currently open. We've got several more opening in the next month or 2, and basically we'll get to that 20 number by the end of the year, roughly. So that's the whole portfolio today. On the product side, we primarily focus on flower and full spectrum concentrates, and our products are under the brand Cloud Cover. All of our production activity is branded. It's under our branding. We haven't done any third-party licensing deals or white label or private labeling. We're in about 300 stores between Oregon and Michigan with our products currently. We are rolling out our wholesale platform in Massachusetts and Missouri this year. So we're looking to expand our door count on the product side. Our retail brand is called High Profile. Today we've got 5 stores open in Michigan, 2 in Missouri, 1 in Oregon. And as I mentioned, there's a number of new locations opening in the coming months. So that's a little bit about the company at a high level. We are private today. We finance the business largely through our own direct relationships, which we'll talk a little bit about today. And we're really focused on continuing to grow in these 4 markets and roll out our platform and bring these assets online that we've spent the last couple of years developing.
That's great. So you haven't been doing much of anything the last few years, in other words.
Yeah, exactly. It hasn't been busy at all.
Okay. So look, we tend to have the single state operators, the multi-state operators. We now have a thing I've started calling multinational operators who are involved in many different countries. You made a choice, as a number have, to go more than 1 state, but for some of the more successful multi-state operators, they've realized that multi-state doesn't need to mean every state. And in fact, some of the multi-states have pulled out of certain states. And so how does the analysis work as you decide what state to go into next? What makes a state attractive? Do you prefer limited license, not limited license? Do you prefer one or another side of the coast, which it doesn't seem like you do? Talk me through that brain power that you put into deciding where to go next.
Yeah, absolutely. I think we're maybe a little bit of an unusual MSO in the industry. If you look back, we've really built this 4-state portfolio basically organically. We've essentially done no M&A to date. And everything that we've done has been through our own efforts of securing real estate, obtaining licenses, building out, and then starting operations. And so it's really been an organic process for us, which I think is different than a lot of the other multi-state operators that have done more M&A. And the reason that I mentioned that is it does sort of reflect our more deliberate, more kind of step-by-step approach to the growth of our business. So as we look back, historically, we've been active in very competitive open markets like Michigan and Oregon. And that's really where we've cut our teeth, is in those types of environments. And the thesis in the beginning was we didn't want to necessarily go and apply for a very competitive license where we may not be awarded a license and not be able to have an operating business. We instead wanted to focus on markets where we knew we could secure licensing. We knew they would be competitive, but we felt very comfortable operating in those competitive environments. And so that's really the genesis of Michigan and Oregon. Those were two states that we were very active in personally. A lot of our leadership team is based in Michigan. My partner Joel is based in Oregon. So those were markets where we knew we could secure licensing. We've always felt very confident and comfortable operating in competitive and open markets. We're not a company that is purely seeking limited license opportunities. And so those open markets have allowed us to really kind of hone our skill set, focus on trying to be best in class when it comes to the product quality and the operations, and really try to build a profitable business even in those competitive environments. Now, with that said, I think we all see some of the incredible opportunities that exist in some of these more limited license environments and some of the states that have higher barriers to entry. So we have started to focus our attention more on expanding into some of those types of markets. And I would put Missouri and Massachusetts into that category. Missouri, as we know, has a limited number of state licenses. It was highly competitive. It's a fairly sizable state from a population standpoint. We do think it'll go rec next year. There's a huge amount of public support for a recreational ballot initiative, which is coming forth. So great market, limited licenses, I think great population metrics. So that's been exciting. Massachusetts has a different set of barriers to entry. It's not capped at the state level, but there are a lot of challenges in developing at the local level in Massachusetts. And so for a market that's 4 or 5 years into recreational, we're still seeing a relatively low number of active production facilities, a relatively low number of retail stores for population. So we have started to take our mindset on being competitive and being best in class, and now bringing it into these more limited license and higher barrier to entry markets. And so our hope is that if we've been successful in the competitive markets and been able to generate significant cash flow and EBITDA margins in those environments, then hopefully that will translate really well for us as we get into some of these less competitive scenarios.
So getting to sort of the topic of this little chat, many of the integrated operators have struggled to reach and sustain profitability, and you have undertaken, that as a mission of sorts to make sure that the bottom line is important, which I know many companies have tried to do, not all successfully. One of the strategies you've employed is a sale leaseback approach of your real estate. Let's talk about that. What led you to it? Why you think it was valuable, and what other similar sort of cost containment strategies have you employed?
Sure. I think, just taking a step back, 2 of our 3 co-founders, Vishal and I, come out of the corporate finance world. And so I spent time as a corporate lawyer and an investment banker in New York before starting this company. Vishal was in private equity. And the reason that I mention that is we are, beyond the product quality and the focus on best-in-class operations, we're also equally focused on cost of capital and balance sheet management. And as we all know, if you're going to build any kind of a sizable platform in cannabis, particularly if it involves the production side of the business, we're going to need a lot of capital. That goes without saying. And so for us, from the beginning, we've always been really focused on what's the best way to raise the capital? How do we raise capital in a way that allows us to build a long-term sustainable business with strong margins, and not just necessarily be focused on the short-term goal of opening a particular facility or getting into a new market? And so it's really kind of underpinned a lot of our broader strategy. And we take a lot of pride in the fact that, we've raised maybe $65 million for this business to date. All of that has been through our own direct relationships. We've never brought in an investment bank or a broker to do that. And so that has allowed us to really control those conversations and those discussions, try to find the most efficient way to capitalize our business, and really try to put this thing together in a way that, again, makes sense from a long-term standpoint. So sale leasebacks have been one sort of tool in our toolkit as we've done that. I think where we differ on the sale leaseback side is we have done our sale leasebacks directly with family offices that we have relationships with. So we're not necessarily going out into the broader institutional market for those deals. And so we have been able to get better pricing than what you'll see with some of the largest players in the market. Also, we've been really focused on sort of the sizing of those deals. A lot of our competitors have financed their entire tenant improvement package, all of the costs related to a facility in those sale leasebacks, and signed, in some cases, 20-year base terms with pretty significant escalations. And we've really been focused on trying to manage those base terms, manage those escalations, and also not fund all of the tenant improvements through the sale leaseback. We do fund a meaningful portion of these deals with equity from our balance sheet. And of course, raising equity has a dilutive impact on us. But we've made that choice of balancing the equity dilution while also not creating what we consider to be an overly burdensome long-term lease profile and sort of a lease burden that we can't manage as markets get more competitive and tighter. So we've really tried to balance those things. And then beyond that, when we've raised equity capital, for example, we've done it through a lot of direct relationships. We've been really focused on the structure of those deals and trying to make sure that there's good alignment long-term with us and our investment partners. We're starting to look at some other debt instruments that are becoming more available in the market. So we may even look at exploring other types of financing besides sale leasebacks as we go into some of our new projects. So it's been a big focus of ours up to this point. It's going to continue to be a big focus. And we do think that long-term, the most successful, profitable businesses are going to be those that are really thoughtful about how they finance their business along the way and really how they manage all this growth that they're trying to finance quickly.
Okay. So with all that said, what keeps you up at night?
What I see, what keeps me up at night, I think is recognizing how dynamic and really competitive of an environment we're in cannabis. And I don't necessarily mean that on a state-specific basis, but across the board, what I see in this industry is a lot of strong companies, a lot of very smart people. We're starting to see huge amounts of product innovation, marketing and branding innovation. I see that mostly, I see that most of that in the competitive states that we're in, like Michigan and Oregon. I think California has just incredible product innovation and brand development happening. So really what keeps me up is just recognizing that there's a lot of amazing companies in this industry and a lot of people that are working really hard to try to advance the product side of things, the customer service, the retail experience. And so I think we just constantly feel like we can't be standing still. We can't just keep doing the things that are working today, but we have to be looking forward and continuing to evolve our business. And there is just a huge amount of scale that we're starting to see in some of the larger public companies. And so I think we all feel the pressure of this race that's happening out there. And, for Vishal and I and Joel and I, it's always been really focused on long-term success, building brand, building strong product quality. But with that said, we have to be able to, stay kind of current with what's happening in the industry. We have to continue to grow our business. And so it's an exciting, dynamic environment, but it's not one that you can sit back and sort of assume that your current success is going to continue in the future.
So let's go there and talk about kind of your forward-looking strategic plan, with the centerpiece of the conversation maybe focused on, where federal legalization is headed. Every single new client I bring either to my law firm or my consulting business, I always ask the same question: how does legalization affect you, and what are you planning to do about it? And what are you betting in terms of when and how that is likely to happen?
Sure.
And so where do you fit in all of that, kind of big picture, 30,000-foot view?
Absolutely. I think starting kind of on our perspective of where things are headed, let me touch on that first. I think that I may have a bit of a more pessimistic or a contrarian view from a lot of folks out there. My view is that it's still going to take many, many years for us to head to a true wide open national marketplace in the U.S. What I think we're going to see in the coming years is some incremental steps taken at the federal level. So we may see things like banking reform. We may see things like the U.S. exchanges opening up. We in the industry certainly hope to see some reform around 280E and the tax treatment of our businesses. But I am personally skeptical that we will be moving away from a state-by-state system anytime soon. I think that What will likely come out of the federal government is something that respects these existing state systems, at least for a period of time. And candidly, we're making a pretty substantial bet around that thesis. And by that, I mean, we're building a lot of infrastructure in each state that's based around these state systems, these state regulatory frameworks. We're creating production facilities in all these markets. And so we're making a bet that it's not going to go to a national market that quickly. And again, from what I see legislatively happening at the federal level, where the parties are at, where some of the key individual senators and Congress people are at, I don't see a very quick movement at the federal level. And I do think that for medium-sized businesses like us, for MSOs that are playing in 4 states or half a dozen states, I do think it's beneficial for there to be a more incremental evolution of federal regulation in this space. I think that doing too much too quickly would be quite disruptive and actually may not benefit consumers and the overall industry. And so I continue to be supportive of forward movement at the federal level. I think bringing down our cost of capital and allowing us to access the U.S. capital markets is really just a no-brainer and something that I hope to see happening very soon. But beyond that, it's really hard to predict, and I'm personally not expecting any very quick movement on broader reform beyond that.
So at the same time, you've got this broad consolidation going on, and part of it is because the capital is flowing more freely. But what do you attribute that to?
I think the capital markets are really excited about the scale and particularly the revenue and cash flow that some of the largest businesses are generating. And I think that there's a straightforward underwriting that you can do in certain limited license markets where you can say there's so much population, there's so many licenses, and it's an easier prediction to make than trying to figure out how a company may do in a more competitive environment based on actual fundamentals. And so I think that's why you're seeing a ton of capital racing into these, the mega MSOs that are building the largest footprints. So I think it makes sense why it's happening. I do think that as the markets open up in a lot of these states and become more competitive, I think the capital markets will also evolve and start to look more at the fundamentals of these companies. And, our hope and our thesis is that they'll start to look at companies like C3 and say, okay, if these guys can generate 35 or 40% EBITDA margins in states like Michigan and Oregon, they must have something figured out when it comes to the operations and the product that is attractive and valuable. And so I think that like in all new industries, there's a cycle that happens. There's a capital market cycle. There's an industry cycle. And so I think we're in that part of the cycle from a capital market standpoint where scale is being awarded and limited licenses are more easily underwritten. But I think like everything that will continue to evolve. And I hope that C3 will be part of a group of companies that is looked at less from a licensing portfolio standpoint, but more from a fundamental standpoint. And that's really what we're working towards.
Last, very important question. Where did the name come from?
So C3 actually references our product brand, which is Cloud Cover Cannabis. So the 3 C's is kind of where that corporate identity comes from. But that's really a corporate brand. We're most focused on people recognizing what we do with Cloud Cover Cannabis and with High Profile, our retail brand. That's really what we're most focused on. So C3 is a holding company. It's how we're recognized at the corporate level, but certainly not what we're promoting in the marketplace.
Well, awesome. There's definitely an important place for these kind of mid-sized companies, and I'm a believer that when legalization happens, there's going to be a strong middle market that will develop below the biggest players, especially since the biggest MSOs are going to be probably bought by big alcohol, big tobacco, big pharma. And what will that leave behind? They say it's going to be giant and brands, but I think there's going to be middle-sized groups that are going to find important niches to take advantage of. And that could be guys like you. So
yeah, absolutely. I hope so.
I'm sorry we didn't have an actual fire to chat next to.
Oh, come on, David. You're going to call me out like that about the fire? Oh,
you got
man.
up the sponsorship cost so we can afford them.
That's right. That's right. Come on. No, just kidding. We absolutely loved having you guys. Next time, the real Fireside coming at you.
Or Beachside would be better.
Well, listen, February. You're going to remember October in New York. October 13th and 14th in New York. We'll be there.
We'll hope. See ya.
Awesome. David, Ankur, thanks a
David.
lot, you guys.
Thanks, Patrick.